Well, good morning, folks. How are you? Welcome, welcome, welcome. Just waiting for the opening tick here so I can get the opening range gap. See if I can hear this old man talking. 4 more seconds. All right, there we go. All right, so we have a mid gap 19,843. So in the upper charts, and I wanted to do that for the micro NASDAQ as well. So for folks that don't have the amount of capital that's required to trade a mini contract, good morning again, by the way. Hope you're doing well. You can trade the micro, and you can actually do very well trading just the micro. And we're going to compare and contrast what we see in relationship between the two. Upper right hand corner chart is the micro December contract, and it's a 15-second chart. And the lower right is the 15-second chart of the mini December contract for NQ. 1-minute charts respectively on the left hand side. Micro NASDAQ for December delivery, upper left, lower left is December contract for the mini. Okay, so really large opening range gap. Always give the chance for the market to try to give the public some reason to chase it when there's a huge gap like that. I have an appointment I have to be at today, so I will certainly do my best to do a execution. If I have to do it on a 15-second, I will. But I'm trying to use the 1 minute for my execution. If I can't do one today during the session, I'll try to do my best to come in and do the afternoon last hour. I'll live stream that. So if I can get an execution off, win or lose, during the live stream, if I get one this morning, I won't be on the last hour trading in a live stream today. But if I can't get one, then I will live stream this afternoon. But I absolutely have to close the stream today at 10:30. So usually I'll say that stuff and I'll stay longer, but that can't happen today. I absolutely have to get out of here. Okay, so look at this huge gap in here. Upper left-hand corner will graphically depict that with this here. Huge gap. And obviously the same thing appears here in the mini. So as most of you know, last week or so, we were really eyeballing that August 27th through to August 29th, 2024, 60-minute relative equal highs on NASDAQ. And when we rolled over Tuesday for September's delivery to December's delivery, that means we're no longer trading or watching the September contract. We're watching the December contract. And I failed to mention what the catalyst was for me to determine the rollover. And I'm watching this over here. You guys are always trying to call me during the live streams, and I'm not interested in talking to you, so stop doing that. That's the problem with the Freedom of Information Act. Everybody can do a search. But I'm going to get a phone number here shortly that's not linked to me at all. And this phone number is going to go away because you all have abused it. All right, so we have a lot of range between where we opened all the way down to mid gap. So 19,843.50 and 19,844 and a half for the micro. So they're very close. It's only off by a tick. Or no, I'm sorry, a full handle. So it's 44.5 for the micro, and the mini showing is 843 and a half. Now, just for the sake of your notes and whatnot, if we weren't seeing such a several hundred handle opening gap, this area right here on the 15-second chart, I would have already used that for institutional or for entry drill. So I would already have a initial position on, but because it's such a large gap, I'm giving a chance for the market to try to make an attempt to run out its initial high. There's plenty of range there, as I showed the other day during FOMC. I was watching another YouTuber cover, what he does, and wasn't trading until the last few minutes when I was going to leave that YouTuber stream. I just put something on and shared it on my Twitter or X. I refuse to call it X. It doesn't make any sense. It sounds pornographic. The execution I'll do today on the micro. I have been asked several times, can I do it on the micro? And how can we use the CFDs? That I will do that tomorrow. So the topic for trading the US 100, the US 500, and US 30, we'll put the chart side by side, and I'll read it with you live. So for the folks that can't trade the futures market, and you're kind of like stuck to just doing CFD trading, like Tom Hugard, for instance, he trades the CFD markets. But as Americans, we're not legally allowed to trade them. Okay, which is why I think it's kind of funny how other influencers will say they're making this much money trading CFDs. How do you justify where that money's coming from? Because you're not legally allowed to do that in the United States. Just a little reason to make you wonder. Okay, so far that's what I was explaining earlier. If we didn't have that several hundred handle gap up, if it was say like a 60 handle, 50 handle, certainly 40 handles, if it would have gapped just that much from yesterday's settlement price, this right here, that would have been an entry for me. But because it's like this, we have that really, really large opening range gap. Always give the opportunity for the market to do like this. Okay, I'm winding down a little bit, and then start running and take out the high, because it could continuously keep going higher. And I expect that type of thing to happen, because I look at that as an amazing trap for retail to say, yeah, I want to keep going. It's broke out. Because think about it like that. Most traders that are retail perspective minded, They like breakouts. They like confirmation type setups where something has done something. It's moved already. Like for instance, they see this and they want to be a buyer now. So they like to chase. They like to use breakouts, and buying above an old high. You're basically buying something that's already been moving up. And how are you going to have a reasonable stop loss when you're buying at the highest high at the time of the session? How much of a retracement are you going to absorb? So it doesn't make sense. But it also affords you the comfort of managing that fear of missing out or impatience. Just simply wait. Let them take the initial high out. If they don't, there's plenty of opportunity to get into the move with a 15-second chart. There's plenty of fair value gaps to trade off of. There's plenty of microstructure turtle soups where it runs up and takes out short-term highs. You don't have to rush to get into it. Okay, so there's the initial highs being taken. So once more, having an understanding of what we're looking for versus impulsively chasing. See how it gives you a peace of mind, comfort. You don't have to be doing something right away just because the market starts trading. Get over here and check this 1 minute chart here. See some analogies, man. I apologize. These are all things that would have been. See that? I incorporated the volume of bounds because I have my good glasses on today, not the old ones. All right, so you can't use this candlestick in 31, no gap, 32, no gap, 33, no gap, no gap, no gap, no, yes. So this is first presented fair value gap. And we'll extend that to the right. And for now, we'll just keep it gray. That way we're not trying to entice any kind of no, what am I doing? There you go. Right. And the same thing for the micro. There's your first presented fair value gap in the micro contract. Right. So we have taken out the initial high of the day after a very large range gap opening. We're not rushing, and we're just going to simply relax and let price give us a scenario that we can trust. And I'll explain what that would look like when it's presented to me. So we got our 19,926 level. I was working with my private group last night, and we were able to capture a lot of that run up. All right, so now we have validated any breakout traders going long. So anyone that bought on the breakout, do you think they feel comfortable right now? We're inside of the initial fair value gap between 9:31 and 10 o'clock from the opening range. Consequent encouragement should have been traded to. Just about, if not. Let's put that back on here for a second. It's got real close to it. We'll call it yes. So there's a couple things it could use here, where it could use the consequent correction of the initial fair value gap, then rally up into touch this one here, or if we leave this all together, come back up and then work the lower half of this gap and treat it as an inversion fair value gap. Traders are caught long buying above this breakout here. All this is retail buying that, and sell side is right here. If you don't mind, I'm just going to work with this single chart because it's a little too much going on. And again, we're favoring the likelihood that we could draw back down into mid gap, which is a good distance down here. Okay, so it's a lot of range to get down there. Doesn't mean it's going to do it today's session. Doesn't mean it's going to do it in the morning session. There you go. Let's see where the bodies are here. Midpoint of this first gap, and then we're up into this inefficiency right here. Okay, now watch the midpoint of this here. I don't have my little settings on. Terrible, 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 Phil. Want to see price stay in the lower half down here and aggressively run below this low here. Don't copy me. Using the micro contract is very, very forgiving, and that should be there. Sorry. So you don't have to be as precise. I was trying to capture it as it was hitting the lowest part of this to illustrate how you don't have to have a lot of risk on, versus if you try to trade with a mini, you want to be a little bit more precise. So in the beginning, you're not going to be comfortable selling it as it goes right up into this gap. And you may get stopped out, and there's nothing to be afraid of if you get stopped out, Caleb. I'm showing you how to work with graduated understanding. We have plenty of time to get in here and take other executions. So think about this high right here, to this high. Get that out of the way, sorry. Let's do it like this. This old high, because we had a large gap, several hundred handles higher, it's likely to do this very thing where it'll drop down initially, create some kind of oversold condition for indicators, some kind of oversold, maybe a divergence of some kind. Harmonic traders, something to that effect, they'll see it's just a cheap price, okay, and then they'll send it higher, taking out that high. So traders that want to be long want to break out because they see how big the move has happened from yesterday to where we're at today. If if they place their orders here to buy on a breakout, those actually become filled and they're hot now up above here. See that? And the market breaks lower. And we had two fair value gaps. So this is model 2022 stuff. In case you ever study that, this is what this is. If you have a fair value gap here, but there's another smaller one just above it, always expect that it's going to go up into the higher one. And it's stabbed into it there. See that? So initial fair value gap, model 2022 first. Then we traded down. And I was trying to time at the low because I wanted to show the lowest entry in this first fair value gap. But this is actually even better because it was outside of that. So you can see how it's already very forgiving. Some of you that live in third world nations, and I don't mean that to be mean or anything like that, but it's just the truth. You know, $65, $80 or so is a big deal where you're at. And just trading with one micro contract can make the grocery bill a lot easier to pay for. So when you're starting out, you can set things in motion for an objective that's just trying to get one single micro contract to yield you $75 to $100, and then have that be a goal every single day. And if you can get to that point where it's not something that's difficult for you, you're not worrying about the money. Okay, you're not worried about the money. You're not worried about the fear of being wrong or the necessity of being right in front of your peers. You're in this little laboratory experiment setting. And now, because you can see that you can take your profit, you can move to the sidelines here, or right now, Caleb, I want you to think about if you don't take it, if you don't take the profit and close it at $75 to $100, what does it feel like knowing that that is the threshold that you're aiming for, but you don't take the profit and just roll your stop? What does it feel like to stay with the trade? Is it easy for you to hold on to it? Is it hard for you to hold on to it? Do you feel any kind of regret anytime the candlestick starts moving back towards your stop loss or your entry? Do you feel any kind of, I wish I would have gotten out, or I wish I would have had a bigger position on? Look how nice this thing dropped down. These are all the things that you're supposed to be journaling. So you want to take screenshots of this. You can use Dad's chart here right now, but you want to record like all in these open spaces here, up in here, all this area here. You want to record what it feels like for you when you're in the trade, and the parameters would be if you get $75 to $100 using the micro. You're not using the mini. You're only using one contract. You can clearly see it offered it to you, but we're saying hypothetically you're not going to do that. You're going to try to stick with, does it want to reach to a little bit lower, which is the upper quadrant level here on the opening range gap. So this would be just a logical price level to see it want to reach for, but do you have the patience presently to hold on to it and disregard anything that happens in price? Because if it comes back up and hits the stop loss, it's not a losing trade. You didn't lose anything, but it's giving you the experience that everyone else, and I can tell you this with my own students, they try to avoid these types of learning experiences because they want it to be, get me in, let me make money, I don't want to get stopped out, and I want it to go right to my target real fast. And this is the stuff that you learn to do. Better trading is done through these types of things here. Having measured approaches, laboratory experiments basically, where you're going in with a minimum expectation. The draw is mid gap, in the first 10, the first 30 minutes. That's what you're trying to aim for. So you're using that built-in little 70% advantage. It doesn't mean it's going to go to mid gap today. It doesn't mean that it won't go higher. It could take the high out. But you need to record what it feels like for you. Are you feeling the excitement, or are you feeling the fear, the anxiety, or I guess the uncertainty? If it's too much for you, you need to record that initially. And over time doing these things, you'll find that it's faster for it to not be present. Here comes a stop. Almost got it. Come on. Come on. Now, not taking the partial, not taking the profit, you have to record, what do you feel? Do you feel regret? Do you feel that it was advantageous to follow the model enough to know that $75 to $100 is offered to you and you don't even need to get to a target? That would be either the upper quadrant or the mid gap. Using the logic over here, mid gap of the first presented fair value gap on the 1 minute chart. The logic was there. Poor execution entry still afforded $75 to $100 in a micro. If you relax and allow, and this is for everyone else that's watching, if you relax and allow that to be your initial targets to start with, just trying to get in and finding this once a day. And when you get it, don't push the demo again, but you can just tape read after that. These are all exercises I gave for my students when we were teaching primarily Forex. And it was not received as well as I thought it would, because it gives you a context of what it is you're doing in front of the price action. If you're going to just sit in the charts and just stare into the ether and not know what you're looking for, you have to experiment. You have to engage with price action, and you have to use the rules that I taught in the content. What things support an idea for the price to go higher or lower? What is the time of the day you're trading? What characteristics are there around that time of day? So if you're just going in here blindly, just watching other live streamers, or if you're in here just trying to chase after price, you're never going to get better at doing that. You're just going to stay doing just that, and you never learn how to trust your own decision making. You won't trust the rules because you're not applying them in a very small, low risk, low yield in terms of excitement conditions. So we went back up and touched the bottom of that fair value gap here. And again, we're on a 15-second chart. So sell side now has moved down to here. And we're focusing primarily on the return back into discounts. So that's going to be this upper quadrant level. This blue line here is the upper 75% level of the highest high to the next quadrant measurement of the total opening range gap. And that's below. So below this low here, if we drop down to tack this sell side liquidity pool, it could trade down below that into the upper quadrant level is what I'm saying. And you look for it, and I'm sorry I didn't say this earlier, but if you watched what I was teaching on the other day, you want to see a 20 handle run potential for the setup. So what I'm doing is I'm watching over here. We're going to go to 20,010 even, and then that's 20 handles. Okay, so what I'm looking for is where a fair value gap, and this could be used for order blocks, it could be any of my PD arrays. It's not just the fair value gap, but any of my PD arrays, whatever one you like to use to trade with. You first have to have the directional bias to some degree, not for the whole day, not for the session, but you have to something that tells you what you're aiming for. And we're electing to stay with the 70% strike rate that it's likely to see it gravitate towards middle of the opening range gap. So say you wanted to use the immediate rebalance here. Would that afford you from that point here to get down to that low? Would that be 20 handles? Sure, it would be. That's that's a that's a range that could be used for an experiment of watching how using that level, tape reading it, how does it behave? Does it run for this high here back into the initial fair value gap? Or does it break below this aggressively and then start to accelerate through this inefficiency and attack that sell side? There has to be some kind of framework what you're looking for. If you don't have it, then you shouldn't be all keyed up about what price is doing. You shouldn't have any emotional response to what price is doing, ever. It doesn't mean you can't cheerlead yourself on when you've done something well, but you shouldn't beat yourself up if you don't do something right. Acknowledge the fact that you didn't do it right, move on. Identify key points where you can improve to hopefully avoid doing it again, and journal that. So for the folks that are looking at their accounts with the funded account companies, and you're out there trying to do these massive, huge trades because you want to make a big payout real fast, that's the worst thing to do. Because if you don't take advantage of the opportunities of building that account up $100 a day with very little risk, extremely low risk, you won't feel emotional. You won't feel scared. You won't be afraid to take any trade because the size that you're risking if you're wrong is so minuscule. Like some of those accounts, and I think if I'm, and forgive me if I say this wrong, but I think it's the lowest ones they offer you like $1,000 maximum loss or something to that effect. But when you're risking 50 bucks or less on a trade and you're trying to make 2 to 1, risk 50 to make 100 bucks. And once you do it, you stop and you do that for a few weeks until you get comfortable being able to do it. Then you go for, okay, well, I want to try to do 2 of them. If you're using a 1 minute, 5 minute, and 15-second time frame as your, 3 time frames to work with high frequency entries, you can do 200, 300 every single day and never risk wild amounts of money. And then because some of you guys are doing these multiple layered up accounts where 10, 15, 20 counts, it's easy to get these wild thresholds met where you get a withdrawal. But if you're in there trying to trade with big contracts, big contract sizes, I'm looking at these relative equal highs here, and then we went back in here to the first fair value gap. Just want to take a quick look at the 1 minute in relationship, because everything I'm doing when I'm doing the live streams, I'm forcing myself to simply use one screen because that's kind of like the closest thing that you're doing. You don't have all the other stuff that I have available to me, so I'm trying to force myself just to use the minimum, the minimalist approach. And again, some of you jokers out there that are watching this just say, oh, look at this, that was a terrible fill. I'm trying to illustrate how in the beginning, Caleb or anyone else that's new, you're not going to time it correctly. Remember, in the beginning, I told you not to use the limit orders. I want you to go in and market it in and then feel what that feels like. Do you have regret about your entry? Do you have a sense of accomplishment that you did a really good entry? So we're watching the high end top of that initial fair value gap over here on the 1 minute chart, upper left hand chart. So we're back inside there. It can spike up and re-deliver to the high of it. I just want to see the body stay at the middle point or below. And if we can manage to do that and then roll outside of it once more, then I think what we'll do is just make an attempt to get down into this inefficiency and attack the sell side here. Otherwise, I'm not interested in going long. So if it rallies, it'll do it without me. But the point is showing what you're measuring, how to time it using the setups. I mean, no one can deny the logic that's being showed here. I mean, it clearly did exactly what I said this morning. And I'm not trying to save face or anything, but I like to remind people because they're constantly out there trying to discourage you, or they'll say things that isn't true about me, like I'm rebranding something else. Get your clicks, lady. But the buy stops here telling you that it was going to run up there first. That gets the retail trader's trap. That's a real trap. I've explained to in advance before it happened. And then trade down into the first presented fair value gap. I told you watch about halfway of this, then shoot up into this upper gap here, and it happened. That's the model 2022 entry. And then it sells off, and then we use the midpoint and treat this as an inversion fair value gap, which is still, it should have been colored here when I traded down to, I apologize. But it's a lot to talk about this over a 15-second chart and see what it is I'm expecting, frame it in a statement that way it makes sense to you, hopefully, and I'm still watching and navigating price. It's not as easy on a 15-second chart to stay up to it and not say something incorrectly or not say it as well as I wished I would have, because I don't have the benefit or luxury of time. Each candlestick's painting quick, so it's not the fact that price is moving fast, it's just the framework around every individual candlestick is painting faster. So the things I want to detail about those individual candlesticks, I have to have my expectation known in advance. Otherwise, I'm not going to be able to keep up with the pace of every individual 15-second. I only have 15 seconds to talk about the candlestick before it closes and a new one begins. So we add a little mohawk here. There's a little portion of this area up here it could be trading up into. And we'll just take the middle level into account. So from this candlestick's high, this candlestick's low, midpoint, that's consequent encroachment. You can see that's traded there, and then look at the reaction off that. That's nice. And the bodies did not lay on top of that mid gap. All right, so now you can watch the consequent encroachment of the inversion fair value gap once more here. So look at this low here. That's a minor, and this is a minor sell side. So keeping in mind, this is the range for 20 handles. Do we see ranges that afford us working from anywhere in here, upper quadrant, mid, lower quadrant, or the low of the inversion fair value gap? Can that yield the potential of moving at least this much? So that's like your minimum expectation or filter that says I have to see if there's a trade forming, and by knowing what you're looking for price action, like where should the setups form, like everything I outlined over here that came to pass. We're waiting for a scenario that builds confidence that we're going to run to a sell side here or run to this sell side here. What would that look like? It would have to be for me, I want to see it leave the inversion fair value gap and stop reaching for any kind of premium. So if we go outside of it, touch it one time with one candlestick, that's it. It doesn't need to just touch it one time. The next displacement after that, that's lower, that would form a fair value gap, that's the one I would sell short on and then aim for. If the range is like, say the entry would be up here, well, looking at this distance or height of price action, if the fair value gap formed in this vicinity, trading to that low right there would afford Caleb a setup. So it's a setup that is meeting the criteria. But if you don't have some kind of a threshold that frames the whole basis of what you're aiming for as a minimum, it has to at least offer 20 handles. If it doesn't afford him 20 handles, then he can't take the trade. And he has to let it just pass. And what happens if it works out where if it was 18 handles and he doesn't take it and it pans out, how should he feel about that? He should feel good that he exercised discipline, that he exercised he had the identification correct. That there was a setup there, but he just says, no, I'm not taking that one because I want to learn how to trade with excellence. I don't want to get in here and just get dirt on my hands. Okay, I want to get in here and walk in here and treat my trading with a white glove approach where I don't get my hands dirty. I go in, I execute like a professional and leave without getting my hands dirty. You're not emotional. You're not freaking out. You're not chasing anything. I like that right there. That's nice. So both of these are cell side, but they're minor. But they can still yield. They can still yield the intended goal. That's on the wrong side. On a micro, Caleb, you're going to be able to do wider stops and it doesn't hurt you that much. So now that's, I like to see that. I don't want to see it close up and get close to this. I want to see this candlestick close down and create. See, it's closed right back in. I can't use that one now. So now we left the inversion fair value gap. We left it. We had one candlestick come back and touch it. So any displacement lower that creates a fair value gap, I'll use that on the 15-second chart to enter. None of this worries me, and it gives you no concern whatsoever. You see how it keeps you from panicking? I'm going to miss a move. It has to do certain things. If it does this, then I will do this. If it keeps doing this, that is not something that's set up for me, then I'm sitting still. I'm not worrying about it. I'm completely content. There's zero fear in what I'm doing here. None. And you might say, well, it's because you're trading with a paper trading account. No, I'm in front of however many people are watching. And all of you have this measurement of me. Oh, it better be perfect or you're not inner circle trader now, are you? It's easy to talk from the sidelines, but get out here. Knowing what you're looking for and how you're going to engage and when you're going to sit still, paramount. That's more important than you trying to make money. Because making money, that's the easy part. The hard part is getting to the part of not going in here impulsively just pushing buttons. All right, now see what it's done? Think about what I've just outlined, Caleb. We wanted to see this displacement below this fair guy, the fair value gap. Easy for you to say, ICT. The first fair value gap of the morning. And I wanted to see it trade below it and show displacement. If this candlestick would have not had this high come back and touch this candlestick's low, that would have been a fair value gap. And then I could have used that one and I would have traded to get down to here. But because it went and touched it, then I have to wait for now another displacement lower where it creates a fair value gap. If it doesn't create one, can I take a losing trade here? No. And you're worried about losing. Why? You're not listening to what it is I'm talking about in all the long stuff, all the drawn out, long, boring stuff to get to the point. The point is I'm teaching you how to do it the correct way and avoid all the problems that I went through and most other traders go through, not realizing there's a better way of doing it and not have to get all that scar tissue that's the result of doing things incorrect. Okay, so we came all the way back up into this gap here. I'm going to make this ugly color because I want it to stand out so you can see. So we bumped this little short-term high here. But what happens if it goes up even more, Michael? You miss out on a big range day. I'm not teaching Caleb to anticipate and expect to know how to know that the daily candlestick's going to do that. These are smaller little modular lessons that will give him, number one, something to do that will allow him to progress in a meaningful and realistic manner, not trying to get some Olympic gold medal result. He doesn't know how to trade. He has no idea how to do it. So, in my opinion, as his dad and as the mentor too, I'm teaching him how to have very low expectations on himself. So that way he can't beat himself up if he doesn't do it right. He's not going to do it right in the beginning. Nobody does. I didn't do it right in the beginning. So you have to build in these allowances for imperfection and set the mark for progressing, you know, in small incremental steps. Make it so that way every day it's easy to get to that cookie or that little reward. Okay, so we bumped the old high here. So this was the initial high today. There. If we take out this high here, we might be seeing a larger run higher. Admittedly, on the daily chart, that is in the cards, but I still wanted to see it offer another opportunity to get towards that mid gap. It doesn't need to fill it today because everything technically is really bullish. So the buy side is not here anymore. It's here. And the question would be is if they already trapped traders here, will we the benefit of taking it above that high? If not, to go higher, longer term into the day. So every day, Caleb, when you first start looking at your charts, you want to frame a little box with 20 handles. And what you want to do is you want to take that after the fact, after the market's already done, moved around and whatnot. You want to be moving and see, okay, like here's a fair value gap right there. And you could have got an entry on it right there. Did this yield 20 handles? Yes. Would it be reasonable to see it trade up to fill in this gap here as a target? And it does, yes. You don't even need to trade all the way back up to the inversion fair value gap. You don't need to see that at all. And doing these types of things, these types of setups happen all day long, going up and going down, going up, going down. And what you're going to learn, and this is for everyone else's benefit, listening, you're going to learn that there are some setups that are going to be easy to spot as something that might deliver, but you're not willing to take it. And that is a huge monumental milestone in your progress because everybody wants to go out and just simply get in and push the button. Everybody wants that. But nobody wants to do the work in preventing needless drawdown. No one wants to do that kind of work because why put all the time in front of the charts or listen to some guy or teacher or go through all the course material of whoever it is you're going to listen to and not start making money right away. And that's the unfortunate, TikTok mentality that is pervasive today. It's too many things forcing you to want to be fast about getting a result that you don't technically have the skill set to expect. It's unreasonable for you to expect the basis of what I'm saying. Now, what I've noticed here is the first fair value gap, it behaved everything here as we would expect it to. When we were down here, I said you can take this off at $75 to $100 and that you would be done. But I'm placed him rather in a condition where the stop was rolled to just make sure the costs were covered, no commission costs would be a factor, and no losing, no drawdown basically. So the reflection on that should be if you have a target in the beginning, $75 or to $100 on one micro, if the trade that you're in yields it to you and you're still trying to learn how to do this, take the profit at $75 to $100. Do it on a limit, do it on a market, exit. And then simply watch what the price does. Go back and listen to the recording. When it was down here, I was explaining that this is what you're looking for. And then you could just comfortably close the trade. And how much time has transpired from the entry? The entry was here. Look where the fill is. It's almost near the worst possible scenario, and it still yielded $75 to $100. At the time I was talking about, it still was yielding $100. How much better would your trade? And listen, folks, everybody wants to be, you know, the the person that stands out. Okay, the person that can do it better than everybody else. Okay, that's what you see on social media right now. If you were making $100 consistently every single day, and that's all you did. Is that improvement based on what you're doing right now? Because I would venture to say that 95% of you are not that profitable. You're not consistently making money. Okay, so how I'm teaching Caleb is if you can make a Benjamin every single day or fail trying to do it but making 75, that's progress that anyone should be proud of. I mean, if I found $100 on the street walking down the sidewalk, I wouldn't look at it and say, I'm not picking you up. But what's the chances of you finding that happen every single day? Not likely. But if you build this skill set I'm showing you, you'll be able to do that every single day. You'll have the opportunity, like walking outside and saying, oh, here's a $100 bill. Let me pick that up and take that, put it in my pocket. And if you learn to be content with that in the beginning, everybody wants to make $1,000 a trade or more. Everybody wants to have $10,000 payout weeks. Everybody wants to make $100,000 six-figure payouts. Everybody wants that stuff right now. But you have to start somewhere small that keeps you motivated while you're learning to be comfortable. You have to trade comfortably. You have to look at things in price action and say, yeah, this makes sense. I expected to see this happen. And this is basically what I'm looking to trade off of. So I'm going to take the first opportunity to get in. But if it doesn't give those parameters for you to get into the trade, teaching what I'm teaching you, Caleb, you're not getting beat up. You're not getting raked across the coals and doing it wrong and entering poorly and getting stopped out. Do you see that? For everyone else that's listening too, do you get that? Because if you're not getting that, you're not picking up on the main lessons. That what we're trying to do is develop self-control and have measured, realistic objectives that could be easily met. All right, so this is 2 times. We made a higher high intraday with a huge opening range gap. We've already worked the initial first presented fair value gap here. We dropped down in here and we didn't get the setup that I was wanting to see here. So this was a raid and this was another crest into a higher high. So we have to hold on to this area right here. Watch what I'm about to show you. This is liquidity, okay? This is another lesson that you ain't gonna see in anybody else's bullshit. This was your initial high. This was the stop run that took out that initial high. All of this shaded area that I highlighted, now that area, you treat that as a balanced price range. Extend that over. We don't need this gap here. Take that off. So now what do we do with this information? You have sell side here. You have a pool of sell side here. You have sell side there. First presented fair value gap down here. This is a balanced price range because it took a run into real orders. This was not contrived. It's not some just random area. This was exactly where buy orders were brought into the marketplace and smart money sold to those individuals to drive them into loss. Because when the retail traders use this area here to go long on a breakout above the initial high of the day here, they're trapped long. So the market's going to gravitate to opposing liquidity. Where's that? Sell side. Where's that? Right below that low. How far can we reasonably expect it to go below this low, Michael? Your handy dandy Fibonacci, place it on your high. That's your highest candle. In all of this swing high, it's anchored to the highest high. Drop it down to the low here. This is the first measurement I gave you. Whenever you have a dealing range and you want to look for external liquidity, measure the range, which is this high here, down to that low. Your first stepping stone to understanding how far prices can go beyond that or outside the range is negative 0.25. That's this level here. Did it trade there? Yes. But if it's going to do a measured run, it's simply just a -1 standard deviation. That's down here. That gets us to that upper quadrant level. In the fib, you graduate from a negative 0.25 level to what's half of the negative 1? It's negative 0.5. Look where the bodies are. When I'm looking at this price leg here, I'm getting an approximation because it's just simply like I'm teaching you, Caleb, to look at these 20 handle runs in measurement and size and getting familiar with what that looks like. This run here to here, half of that run was when we were down here, when it was trading at $75 to $100 open unrealized profit. That's why I'm saying close that. If you were in a day that didn't have this multiple 100 handle opening gap, you could take this as a partial and then aim for the upper quadrant level of the opening range gap. That's what this level is here. And then if it's going to go down below that, which is likely, what would it reach for? One standard deviation or a measured move of this high to that low projected below this low takes us down to here. But because we have a huge gap, chances are it can do what? Continuation. But initially, while you're in the opening range of the day, not the opening range gap, the opening range, which is 9:30 in the morning Eastern time to 10 o'clock, after a very large opening range gap higher, always expect them to drop it down, create an initial high of the day, and then run that. And then there's a deeper retracement into it. Whether it gets to the mid gap, upper quadrant level, doesn't matter. It frames the logic where you can take a very easy bread and butter setup, which is what I outlined. All of this here was that. But I showed you what it's like if you don't take the partial or if you don't take the close off, if you don't take the one single contract you're working with, Caleb, and close it when you get $75 to $100 in open profit and record what it feels like to do that and record every single day and do it. Stop when you get it. Don't push the buttons anymore. Having that consistency, that ability to see something, and then you capitalize on it and you realize it and you take it home in the results, it builds your confidence, but it's not overconfidence because remember, it's just $75 to $100. But now when you take the logic that's being used by taking a setup like this and capturing a move down to where you get to 75 to 100, what happens when it becomes a mini contract? Then it gets a little bit more exciting. Then you start making your weekly salary at your job in one of these little bread and butter setups. Just one of them, not an everyday thing, just one of them yields that. And then what happens is it becomes much more beneficial for you to be selective about what setups you take. And you don't have to be trading every single day. But in the beginning, you need to be doing a lot of these types of setups because it desensitizes you to, yeah, I know I can find lots of setups. I know I can find lots of setups and I don't need to be fearful of missing any of them. But I have 2 minutes left. All right, so I covered a bunch of stuff. For the folks that say I trade order blocks and that's support and demand, supply and demand, or what is it, support and resistance? No, but I can teach you how to find the levels that classic support and resistance would hope to be able to pick. But there's never been a book out there, and I have over 2,000 of them. There's never been a book that has communicated how to find the right support level or the right resistance level. And I'm using those terms, right, those correct ones. Just like I've never seen a book that showed you how to pick the right diagonal support trend line or diagonal resistance trend line. It's so subjective. It's a farce, really. But when you look at this initial high, it's unreasonable based on what I taught you today and what I taught in core content lessons too and mentorship. It's unreasonable to anticipate the market to come right back up to that high and stop as resistance. But it is reasonable based on algorithmic principles that it will go above that high to get the orders for the express purposes of going lower to attack them. So they're targeting retail mindset. That's why retail concepts is not what I don't trade with that stuff. Just because you see me drawing a box or drawing a trend line segment to highlight a very specific price level for you to focus on, we're attacking that level. Okay, that's what we're doing. We're targeting it. I'm not using this old high to say I want to sell short at that price level. No, I'm expecting it to go up there and spend some time up there. Why? Because it's going to accumulate what? The orders that would be sitting there and then drop it down to attack the mindset that retail traders use, which is buying momentum, buying a breakout, selling a breakout. They're never trading against the direction of their intended profit. In other words, if they're bullish, they're never entering when the market's dropping. They're not doing that. It's scary to them because they don't know what they're doing. But I'm doing that. I'm going in and teaching you how to capitalize on that counter move. You're running against the wind, and that's exactly how you hang glide. That's how planes fly to heights that, you know, if you want to stay on the ground, trade with those retail concepts. You're never going to fly. But you have to run into the resistance of oncoming wind. You have to put your wings in that. Open your parachute, and you'll be able to glide on that. But if you're trying to chase something, that's like finding an air pocket. You're going to fall. Just like you feel when you're in an airplane. You feel that turbulence. You're not getting lift. So what happens? You fall. And you wonder why retail logic causes you to go into drawdown and lose. Because you're placing so much emphasis on things that aren't going to give you what you're hoping they're going to give you. But you're allowing yourself to be beaten up in that toxic relationship and say, well, it's normal because the markets are random. Nobody knows what price is going to do. Well, I'm Mr. Nobody. So here's the thing. This high here, it's not going to be resistance. It's going to be absorbing buy stops above that. So when it does this very thing here, this creates this whole pocket. It becomes a balanced price range. That means that this high will absolutely be just like a support and resistance book will tell you. Okay, here's resistance broken, turn support. Now tell me, find a fucking book that tells you how to give that logic where it's the right support and resistance. How to know when a support and resistance level is going to be really a support and resistance level and not being swept for the purposes of gathering the liquidity above or below them. I'm sorry, Toots, but your ass is absolutely ass backwards. You want clout? I gave it to you. I tweeted your shit. I hope you make more videos because I'm going to have fun with you. Everything that these people were going to tell you, if this was logic that's borrowed from someone else, somebody else would be doing it. They would explain it beforehand. They would tell you which supplier demand zone is going to be the one. They would use a very small, ultra small stop loss, and they would get targets hit. Just like that. But you ain't seeing that. Okay? You're not seeing that. But I'm showing it to you. I'm giving you the why. I'm giving you the when. I'm telling you how to do it. But as my son, as the target audience here, you have to move very slow and small incremental steps. Okay? And what you see dad doing, you'll be able to do that stuff. It's just you have to start here first. And that way you won't feel any regret. You won't chase big fast money because that's easy. In the Navy SEALs, I'm going to say this and I'm going to close it. In the Navy SEALs, they have an expression: slow is smooth, and smooth is fast. Meaning, when you move slow, you're moving smoothly. You're less likely to make a mistake, and because you're not making mistakes, you're moving fast. You're all trying to get to a profitable, consistent lifestyle as a trader where you're making big money. That big money is waiting for you. You keep pushing it further away by trying to run to it faster than you can. You haven't even learned how to crawl yet. You haven't learned how to walk. You haven't learned how to walk briskly and then run. When you're really good and you know what you're looking for, you can run these markets up, down, all over the place, buying and selling all day long. I've made over 1,400 handles just in the last 2 3/4 weeks. And I have students that can verify that. Some of it you watch me do publicly. Other stuff they saw. I regret sometimes saying that because it sounds like, and there's people out there saying, I'm going to do a mentorship in 2025. No, I'm not. I'm never doing another mentorship where you're paying me money. But I do have this group that sits with me, and I show them what I'm doing, and I'm walking them through what I'm walking you through here. Watch this, watch this. It's going to behave here. It's going to reach here. It shouldn't go below here. I'm tape reading them. I'm giving them my internal dialogue. It's important for you to do that on your own, Caleb, based on the things I'm giving you as just foundational principles, and then building on that. If I don't tell you everything, it forces you to do what? Expand your discomfort zone. See, when you don't know something, it's uncomfortable. And when you're looking at these candlesticks, what's it going to do next? What's going to do next? You don't have to worry about that, because what you're looking for is what matters most to you and your model. And like it did down here, it didn't give the setup that would have yielded a losing trade. That's the benefit of knowing what to do and when not to do something. I don't regret not capturing along here. I don't regret not shorting up here. These are all things I was outlining, but I'm teaching you, Caleb, to use that first fair value gap. It has to be framed off of that. It can be used as a bullish scenario. It can be used as a bearish scenario, but your focus is right here. Do you see the benefits of knowing what that does for you? There's all these little gaps in here. Which one are you going to pick? That's the same question that every other student in the world has of me. Which fair value gap? So I removed that problem for you and everybody else that wants to listen to me. Use the very first one that's presented on the 1 minute chart, because that'll give you enough to start with. In time, you'll find that there are other fair value gaps on time-based delivery that will be meaningful to you as well. It's not just simply the first one, but that's the first one that can't hide, right? That's the first one that's presented in price action that they cannot hide from you. So it gives you your immediate initial focus. Your bias initially is going to be always looking for middle of the gap. I'm making it binary. If it's this, then you do that. If it's that, then you do this. If neither of these scenarios are there, you do nothing, you sit still. If then, else. That's programming. That's computer programming. That's how a programmer would build with code to the project specifications. This is what I want at the end. I need a payroll program that does this, and runs reports on these primary statistics that I want to have. And then a coder sits down and says, okay, well, I can do that, and codes it out. Well, in trading, because it's algorithmically delivered, you have to have your arrays where you're going to get the information from. Where is the first setup going to form? Every single time you sit in front of the charts, Caleb, it's going to happen in the morning session. Where are you going to look for that setup to form? That's an array. That's a data point. Just like a program's going to go and, okay, I need to do this calculation, I need to get the source information. So that data, where is it? Well, it's in that first 30 minutes of trading. What is the first data point? Where we first open up at. The first 9:30 print in relationship to where we settled previous day. So you have two arrays of information right there. Are we above or below at the opening at 9:30? If we're above, okay, what's the midpoint between those two price points? Yesterday's settlement price at 414 and 9:30 opening price today. If we're opening higher at 9:30 today, that means that the initial draw or the bias for you is going to be lower. And you are submitting to the idea that it doesn't need to get to that midpoint gap. It doesn't need the price there yet. But that's your bias. And then you're waiting until 931's candlestick closes. And then at 932, if 931 creates a fair value gap, that's your first fair value gap of the day. That is your focus point for the range that your setup is going to form at or near. Right away, that's already smashed the shit out of everybody else's stuff, because everybody else's stuff is reacting to things. We're anticipating. We are fucking predicting the future. That's what you're trading. Futures. It's in the name of the fucking game. If you're not predicting the future, you're fucking clueless. You're clueless. And I am not making guesses. And I am not teaching you, son, to make fucking guesses like these yahoos out there. These people are fucking idiots. They're fucking clowns. They think they're smart. They have no idea where they're at. Zero. They have zero fucking understanding. My students have seen me do this and they're able to do this. And you're going to do it too. You are going to fucking run circles around these fucking jerks. But let them talk because that is liquidity. That's the people up here. That's the people that are selling short down here. That's the people that you're targeting. They're your fucking food, son. They're your food. Don't worry about it. Don't play with your fucking food, okay? Don't worry about them because they're going to keep coming to the watering hole and you eat. Don't feel sorry for them. Don't apologize to them when you get ready to take them out. Devour them. Fucking devour them. They're food for you. They're food. Just simply consume them. That's all you have to do. That's what trading is. You don't feel sorry for the other person outside of your trade. Fuck them. They made the mistake. Let them live with it. If they're smart, they'll come back and bounce and get it back and drawdown recover. If they can't recover their drawdown, they don't fucking deserve to be here. They should be food and exterminated. That's the economy in this business, folks. If that's jarring for you, if that's unsettling for you, get over it because that's exactly what you're going to have happen to you when you do it wrong. Your food. Someone got you. Someone devoured you. Someone took your money. But until you look at the market like this, like it's war, like it's survival of the fittest, predator and prey, what would you rather be? The animal looking up, expecting any moment darkness to descend upon them? Or looking down at the meal and not needing to apologize? That's the mindset. That's what it requires. If you go in here and think you're looking at classical musical notes on a sheet of paper, that's not how it works. You're lying to yourself. This is war. And the people on the other side of your trade want you to fail. I want all of you, if you're on the other side of my trade, I want every single one of you to lose. If I was on the other side of your trade, you'd want me to lose. Why is there any shame? There ain't none. If you understand the economy of this industry, that's how it works. So you have to look for the advantages that everybody else makes the same mistakes. Outside of the logic I'm teaching, they all make the same fucking mistakes. And they think with their myopic perspectives because I dress a chart a certain way. Oh, that's a sell and so. Time and price theory. My time and price theory is fucking macros. That means 20-minute intervals every single hour of every single day. The last 10 minutes before the top of the hour and the first 10 minutes of the top of the hour. Every single hour. That's my time and price theory. I'm not using geometrical fucking shapes. I'm not looking at diagonal trend lines. I'm not looking at Gann. Gann is absolute fucking bullshit. I've said this before. It's bullshit. That's nowhere in my charts. It's never being implemented. None of that stuff. I'm looking for time when the market should start running. It's spooling it, and it's going to be running for liquidity or inefficiency. So it means I already know what I'm looking for time-wise. I'm setting my watch to, I'm going to set an expectation. I'm going to look for a setup at every fucking hour. Can you do that with your harmonic horse shit? Can you do that with your Elliott wave? Can you tell me at every single hour that you're going to get a fucking setup, that you know when that fucking setup's going to form? Can you do that? You fucking can't. You cannot do that. So how the fuck are we on the same playing field? We're not, baby. I'm way the fuck up here in the fucking stratosphere looking down at all you fucking piss ants. You have no idea who the fuck's talking to you. You have no idea where the fuck I am from, what I'm fucking done, and what I know. You are fucking clowns. Keep making your dumb shit. We're all laughing at you. Nowhere near the same fucking playing field. It's unfair. The advantages are so unfair. And what's funny is you can't even recognize it. You can't recognize it. So imagine the humor. Imagine the fucking humor. I hope this person and anybody else that talks that nonsense, I can't wait to watch them live stream. I can't wait to see what the fuck they do. Because I'm going to fade every fucking thing they do. And I'm going to explain why that bullshit ain't working. So please schedule your live stream and I'm going to fucking show you what you fucking don't know. And this is an open invitation to anybody. I don't give a fuck who you are. Let's have some fun. I'm here for it. I told you the fall of this year was going to be fucking fun. And I'm here for it. But you have to understand something. Just because a fucking trend line, a straight line drawing from one point to the next, doesn't mean that I'm a trend line trader. Doesn't mean that I'm trading uh, support or resistance. It doesn't mean that I'm trading supply and demand when I highlight a very specific price range that is a order block. And it is not a bunch of orders. Okay, order blocks don't make price go up. You fucking people don't know what you're talking about. You literally don't know what the fuck you're talking about. An order block is two specific price levels. Two. One's afforded for the initial entry for smart money, and the second one, if it's given, they can add to it. That's what's really going on in those specific time intervals that I'm pointing to at any given time. That's what's really going on. It's an algorithmic delivery where price is being offered at that price, not a zone, not some fucking milli vanilli area where who the hell knows what you're trying to get. I know exactly what I'm trying to get. Look at my fucking executions. Look at the logic. Look at the things I'm telling you as the tape is printing on these lower time frames and how it's stopping right to the fucking tick. It's behaving what I tell you it's going to do, how it's going to behave. And when it doesn't do that, it gives me insight and tells me it's going to go to this liquidity or this inefficiency or this specific PD array. It's laughable. I mean, I love it. I wish more people made more videos like that. I swear. I wish you would do more of that stuff. Because all it does, it saturates the market with more proof that you fucking people are stupid. Because once my students see this stuff and they make money with it in their own hands, you're never convincing them otherwise. And we're all in on the fucking joke. You're a clown. And you understand why now I've always laughed at people like this. That's why I sound arrogant and pompous and narcissistic, because idiots are trying to tell me what they don't know. Like, you don't know. You simply don't know. And it's not for a lack of opportunity, because I have it out here for free. Who's the idiot here? Who's the fool here? Someone that can tell you beforehand and then execute on it and then made millionaire students with it. Millionaire students. Not just I got a payout. Millionaire students. You're gonna come talking to me. I fucking love it. I love it. Get your fucking ad revenue, lady. Christmas is fucking coming. That way you can put some stamps on the fucking Christmas cards and send them out. I will be with you tomorrow. If I can, if I absolutely can work it out, I will be with you the last hour today. Okay, because I want to be able to prove to you that we can we can do more than what's being shown here. But Caleb, you have plenty to work with here. You have plenty to start with as a framework. There's no guesswork in it. You're going by the numbers. Time of day, very specific measurements in time, very specific measurements in what price you're looking for. Not a zone, not a diagonal trend line, not some horseshit Elliott wave garbage. None of that stuff. Okay. The measurements of Fibonacci are just simply giving me measurements of a range and what beyond that range, if it trades beyond it, what level, if it agrees with another PD array. That's the secret of Fibonacci. Because you can have all the Fibonacci extensions you want and all the retracements you want. It doesn't mean price is going to do shit there. It doesn't mean that. But what happens if you have a price range that's moved higher and then it retraces lower into a 62 to 79% tracing level? That's the golden ratio. I didn't invent that. It's a 3/4 pullback. By itself, you can do that all day long, and fail. But what happens when there's a PD array that agrees with that, and it's also in a macro time 10 minutes to the top of the hour or 10 minutes after that same hour? Now you have a loaded deal. It's going to trade. It's going to run. It may not run 100 handles, but it's going to run back to the top of the range that you're framing for that Fibonacci, and that's all you need is a bread and butter setup. See, I can use all your tools against you. I can use all your retail horseshit. I can pick the right support and resistance. I can pick the right fucking trend line. I can pick all the fucking supply and demand zones that are really the ones that make money. Why are all these people out there failing when they try to use supply and demand? Why am I able to tell you beforehand when am I getting it wrong? Have you seen that? Have you noticed that lately? Have you noticed that? Why is my shit in my hands work better than everything else? I can do the same thing with indicators. I can take a buy and sell based on divergence that works. The real divergence. I used to lose money all the time trading bullish divergences. But bullish divergences that occur in a stochastics or a RSI or a MACD, and you have a bullish scenario based on a order block or inefficiency with a fair value gap, and it's inside of a macro, there you go. Now your indicators fucking work. Now they will work. The secret recipe that you never have is ICT. If you don't put ICT in your shit, you got nothing. Honey, I'm the sweet in the tea. Okay? I'm the spice that makes it so fucking nice. I am the thing that the cherry on top. I'm what makes it good. You don't have me in it, it ain't working. How about that? How's that for narcissism? How's that for arrogance? Without me, your shit doesn't work. Period. Look at every one of your losing trades. I guarantee you're against what I'm teaching. Then look at your winning trades, and they're going to be in alignment. And you're not going to know or recognize that that's the reason why your trade worked. How about that for a fucking video? Do a documentary on that, you fucking clowns. You have no idea what you're talking about. I could flip this around and make a mockery of every other fucking style and show them how it fails and how to make it work. I got plenty of opportunities to make shit like that. But I'm busy doing this. I'm busy predicting the future. I'm busy teaching how other people can be millionaires for free. So that's it for today. Low risk, low yield laboratory experiments, $75 to $100 a day. Time, very specific price levels, very specific draws on liquidity. The initial draw is 50% of the gap. If you work with this in the beginning, Caleb, don't ask beyond that. Don't ask me what about this and what about that. Just stick with this. Do it for a couple weeks. Look at your charts and and back testing it. Look and see, and you'll see these setups are there every single day. And then when you have the ability to do it, watch it with the tape live. You're not pushing the button, but you're going to watch these types of things pan out. And then after you do 2 or 3 weeks of that, then you can go and start pressing the button with one contract on a micro. And then test the theory. Just test it and desensitize yourself to the worries about making money or losing money. And that's what all of you should do too, in that order, in that natural progression. That way you go through the process of eliminating all of the I have to make money or I'm afraid I'm going to lose money. Don't worry about none of that stuff. All that stuff is things that it's going to work itself out. If you do everything I'm teaching, that's going to be the least of your concern. And until I talk to you either later today, I'll let you know in my community post and or on Twitter. I'll try to, if I'm going to be on there, I'll do both. I'll tweet it and I'll say it on my community post. Otherwise, the only post you see on my community post will be, what did you learn today? And for the jackasses, they'll say, we watched you not take the profit and the market went the other direction. And that's exactly what I want you to see. Until I talk to you later, be safe.